Hello and welcome to the Wealth and Wisdom Show. I'm James DeGeorgia. Joining us today is Stephen Katzman, an accomplished securities litigator from Boca Raton, and Richard Lehman, a tax attorney formerly with the Chief Counsel's Office of the Internal Revenue Service. They're here today to discuss the Securities Insurance Protection Corporation and its role in the $50 billion Madoff scandal. Welcome to the show, both of you.
Thank you.
Well, right off the bat, I've been hearing with regards to the scandal that part of the scandal is covered by something called SIPC, a Securities Insurance Protection Corporation. What exactly is SIPC, and should somebody who's been caught up in the Madoff scandal be going through SIPC for a claim?
Those are excellent questions that are going to affect an awful lot of people. SIPC is actually a fund that all of the broker members have contributed to in order to protect customers from the risk of an insolvency loss, in other words, a brokerage firm going out of business. It really is not designed to cover trading losses or fraud losses, so it's for a different purpose. But here, the Madoff Investments LLC firm did become insolvent and did go out of business, so there is SIPC coverage. The other question you asked is much more difficult to answer because it really gets decided on a case-by-case basis, which is, should somebody make a SIPC claim? At first blush, well, of course, if there's money to cover a claim, why wouldn't you make it? But here, unfortunately, it's a much more complicated question than that because SIPC is working through the New York court-appointed receiver who has made it clear that they are going to be using what they call clawbacks and asking investors who took money out to put that money back in before they may get any SIPC coverage. And there are limitations on what the SIPC coverage will really get you. A lot of people have heard it covers up to $500,000 per claim. But that may be a little misleading because it covers up to $100,000 in cash, the balance in securities. But here, securities are bought in what's called street name. And so there's no way to know whether the securities that are being held and are located by the receiver are yours or somebody else's. In short, it's a real mess. And if somebody files a SIPC claim, there may be some unforeseen consequences. They may subject themselves to the jurisdiction of the New York courts and be subject to claims that they have to pay money back in, which may be greater than the money they get back out. So it really depends on your particular circumstances, and that's why it's really important to talk to somebody who's experienced in this area and understands it. Some people are calling the SIPC claims form that went out the Trojan horse because it looks very attractive, like it's a gift, but there may be a lot of trappings inside for the unwary.
Well, let's talk about some of those risks. You mentioned that only $100,000 is covered in cash. This is a Ponzi scheme that took place where maybe none of the money handled by Mr. Madoff was ever really invested in security. So the money's just basically vanished or been dissipated through either returning money on demand early in the crisis or spent for capital purposes, directed by Mr. Madoff. If there's no securities at all, and all you can get is $100,000, and maybe you've taken $20,000 or $30,000 in earnings over the past few years, you could basically be in a situation where you're only really eligible for, you have to pay the money back in, and you may wind up getting less back than you have to pay back in to cover, the manipulations. But somebody who's looking at the securities part of it is really thinking they're going to get something. That's not true?
It probably is not going to work out that way. Now, in your question, you based part of the premise on there being no trading activity and no securities. I don't think that's the case. But there wasn't $50 billion of trading activity. So there are going to be securities that are going to be located, but whether or not those securities can be traced to specific customers is a great challenge. And if not, what happens? They go into a pot. Are they going to be divided pro rata? There's a lot of unresolved questions there. But you're dead on the mark when you say that for some people who happen to have pulled money out over time, there is the possibility that they could be asked to put more back in than they may get as their share coming out. look at the SIPC claim form, it certainly contains red flags for professionals like Richard and myself. On one hand, the first question is, well, attach your last account statement. Tell us what you have in cash and securities. Well, that sounds positive for everybody because that's going to show a very, very large amount of fictitious holdings. But by about the third major question area, they're now asking you to account for documentation showing how much money you actually put in and how much money you actually took out. And I think that's the information that the receiver is really looking for, and that's going to be the driving force limiting what people may be able to get out of the receiver, out of SIPC, or any bankruptcy proceedings. But I do think when it all shakes out, people are going to find they're paying out a lot less than they had hoped for. You know, being a lawyer, of course, I'm good at arguing both sides of a proposition.
Right.
So you're correct in saying SIPC was never designed to cover Ponzi schemes or intentional fraud. But it was designed to cover the insolvency of a brokerage firm, which here may have been a byproduct of the fraud, but is nevertheless an event that occurred. So that insolvency has left covered SIPC claims.
Now, SIPC has what kind of assets to cover, you know, these types of claims?
Well, unless we get some help from Congress, it appears at present that there is approximately $1.6 billion to cover claims from over 8,000 claimants. And even that is an understatement because many people invested through feeder firms or invested jointly in a single account. And when the claim forms were sent out, that was based upon account holders' names, not necessarily all of the investors. So the pool of victims is much larger than the 8,000 claims.
It doesn't, and in those 8,000 claims, are they including the claims from professional brokerage or money managers who went, wholesaled and brought business to Madoff?
Presumably, yes, but that raises its own litany of questions.
Because that one brokerage firm could have brought 1,000 people that are not on their books.
That's absolutely correct. And so one of the questions we're frequently asked is, can I file a claim even though I was not a direct investor? And no one really knows what SIPC's going to do with those claim forms. But if you decide based upon your own personal circumstances that it makes sense to file the SIPC claim, that the risks of New York jurisdiction and clawback claims does not outweigh the possibility of getting a check in the mail, no harm, no foul. File the claim with your supporting documentation. And not only that, if you actually look at the SIPC claim form itself, in announcing its March 4th filing deadline, now I want to be clear that the trustee has to receive the claim by March 4th. It's not good enough to mail it out by then. But in any event, right in the claims form, it announces 4 or 5 other claims and separate filing deadlines. So obviously, SIPC is under tremendous pressure right now, responding to claims on many different fronts.
Well, let's talk about the time periods for the claims. There are time limits. With the Madoff case, is there a time limit already established?
There is, and it's somewhat scary to me that people are being forced to file their claim so it is received by the trustee by March 4, 2009, before those people know what the Madoff Investments' own records are going to show. So at the time you're filing the claim, you're not sure whether or not there was trading activity in your account, whether there were profits or losses, but you know you've been paying taxes on reported profits for many, many years. And as Richard had explained in one of our earlier discussions, if you proceed with a SIPC claim or with claims through the receiver and they report a certain likelihood of recovery, that can be held against you when you're actually filing, whether it's a theft loss or for a refund of taxes you paid on interest or dividends that you never really got. So we're advising clients to see their professionals and to make sure that they put the appropriate caveats in any SIPC form that they may file a claim on to make sure that they are preserving all of their rights and recognizing that there is a low likelihood of collection through the receivership or bankruptcy or other litigation avenues so that they're not jeopardizing their tax planning.
Are there any provisions with SIPC that allow extensions on that deadline of March 4th?
No.